Welcome back. In our last explainer, we really dove deep into equity funds. You know, the growth engine for a portfolio. Well, today we're exploring the rest of the universe. We're talking about the funds that are all about stability, balance, and hitting those specific life goals. All right, let's get right into it.
Yeah, that's a great question, right? Because while growth is super exciting, any solid investment strategy really needs an anchor. You need something that can provide steady, more predictable returns. And that is exactly what we're going to unpack today. So here's the plan for our journey. We're going to start with the absolute bedrock of stability, debt funds. Then we'll see how you can get the best of both worlds with hybrid funds, cover some really specialized funds for specific goals, and then, of course, wrap it all up with how you can actually choose your own path. First up, let's talk about that foundation. You know, if equity funds are the sails on a ship catching all that wind, well, debt funds are the keel, deep in the water, keeping the whole thing steady. So what exactly is a debt fund? Well, instead of buying a piece of a company, these funds are basically lending money, either to big corporations or to the government. And in return for that loan, they get paid interest. The goal here isn't to hit a grand slam. It's all about consistently getting on base with stable, predictable income. Now, you might hear that there are 16 different official categories of debt funds. And your first thought might be, whoa, that's a lot. But don't worry, it's not as complicated as it sounds. They can all be grouped together in a really logical way, mostly based on just one simple idea: time. And this slide just lays it out perfectly. I mean, if you need to park your money for literally a single day, there's an overnight fund for that. For a few weeks or months, a liquid fund is your go-to. And as your time horizon gets longer, from a few months to a few years, you just move right up that duration ladder. The key thing to remember is, the fund's name pretty much tells you exactly how long you should be thinking about investing for. But you know, time isn't the only thing that matters. You can also choose a debt fund based on who they're lending money to. And that choice determines the level of risk and, of course, the potential return. It creates this whole spectrum from super safe to a little more adventurous. So let's break down what that actually looks like. Okay, check this out. This table really maps out that risk spectrum. On one end, you've got gilt funds. They invest in government securities. Think of them as gilt-edged or top quality. They have the lowest possible risk that the borrower won't pay you back. Then you have corporate bond funds, which stick to the safest, highest-rated companies. But if you're willing to take on a bit more risk for a potentially higher return, a credit risk fund lends to lower-rated companies. It's all about that classic risk-reward trade-off. And it gets even smarter. There are other clever strategies for navigating the markets. For example, a dynamic bond fund gives the fund manager total freedom to change the investment duration based on where they think interest rates are headed. And floater funds, well, they invest in bonds where the interest rate actually floats up when market rates rise, which is a great way to protect your returns. These are definitely more active strategies for people who want their fund to adapt. Okay, so we've covered stability with debt funds. We get it. But what if you don't want to choose between stability and growth? What if you want a little bit of both? Well, that's where hybrid funds come into the picture. A hybrid fund is, well, it's exactly what it sounds like. It's one single fund that holds a mix of assets, usually stocks for that growth potential and bonds for stability. The whole idea is to give you a balanced portfolio without you having to go out and buy two separate funds. So let's look at the different flavors. First up, you've got the conservative hybrid fund. And you can see right here, it is heavily weighted toward the safety of debt, with just a little slice of equity mixed in. This is perfect for someone who's maybe getting closer to retirement and wants returns that are a bit better than a fixed deposit, but really can't handle big market swings. Next up, the balanced hybrid fund. This is your classic middle-of-the-road approach. It's a roughly even split, 50-50, between stocks and bonds. It's aiming for some moderate growth, but it keeps a serious safety net in place. This is great for an investor with a medium-term goal who wants a true balance between risk and reward. And then, on the other end of the spectrum, we have the aggressive hybrid fund. This one totally flips the script. The majority of its money is in stocks, going for high growth potential. That little bit of debt is still there, kind of like a cushion for when the market gets choppy. This makes it a really good fit for, say, a younger investor with a long time horizon.
And just like with debt funds, you've got more dynamic strategies here too. Some funds will literally change the mix of stocks and bonds for you based on what the market is doing, buying more stocks when things are cheap and less when they're expensive. Others, called multi-asset funds, might even throw a third asset in there, like gold, which often zigs when stocks and bonds zag, giving you another layer of diversification.
All right, let's switch gears for a second. We're going to talk about a couple of categories that are less for general, everyday investing and more like specialized tools that are designed to help you do one very specific job.
These are called solution-oriented schemes, and the purpose is right there in the name. They're built to solve for a single major life event. The big thing here, the key feature, is a mandatory lock-in period, and that's there on purpose, to basically enforce the discipline you need to reach that big long-term goal.
And this slide makes it super clear how that works. For retirement funds, your money is locked in for at least 5 years or until you hit retirement age, whichever comes later. And it's a similar deal for children's funds, locked for 5 years or until the child turns 18. It's just a really disciplined way to make sure you're saving for those huge milestones.
And finally, let's just quickly touch on two other popular ways these funds are structured. You've got index funds and ETFs. They're based on a really simple idea. Instead of trying to pick winning stocks, why not just own the whole market? So they just aim to mirror an index, like the Nifty 50. This is called a passive approach, and it usually means very low costs. The main difference? You buy an index fund at its end-of-day price, while an ETF trades all day on the stock exchange, just like a stock. Then there's a fund of funds, which is literally a mutual fund that invests in other mutual funds. It's like getting a pre-made, diversified portfolio all in one shot.
So, wow. We have covered a massive amount of ground, right? From the stability of debt funds, to the balance of hybrids, to the focus of solution-oriented schemes. But now, for the most important part, how do you actually use all this information?
Honestly, it all comes down to these three simple questions. What are you saving for? How much sleep will you lose if the market goes down? And when do you need this money back? Your answers to these questions will point you directly to the right category we've talked about today. A short-term goal like a down payment, that probably points to a short-duration debt fund. A long-term goal like retirement and you're okay with risk, an aggressive hybrid fund might be the right fit.
And that really is the main takeaway from all of this. This huge menu of mutual funds, it isn't there to confuse you. It's there to provide a perfect fit for every single person's unique combination of goals, risk, and time.
So we've laid out the map of the mutual fund world, well beyond just stocks. The only question left is, where does your journey take you from here? In our next explainer, we're going to tackle how to actually pick a specific fund once you've figured out your category. Thanks for joining me.